You're listening to Fund Shack. I'm Moss Butler, and I'm here at the SuperReturn conference in Berlin, the capital of private capital, with Michael Schad, partner and head of credit secondaries at Coller Capital. The firm was a pioneer in private equity secondaries back in the 90s, and today it manages nearly $40 billion in assets. Michael, Coller Capital really needs no introduction in terms of secondaries. It's had a very consistent focus on that. Private credit secondaries is newer. How new is it? Because the private credit market isn't that old.
Yeah, look, I mean, it is definitely one of the newer things within secondaries. And I think one of the buzzwords at the moment, or everyone wants to be part of the private credit secondaries market. For me and for us at Coller, actually, it's not a new thing. We actually have been doing this since the financial crisis in 2007, 2008, when we started making our first private credit secondaries investments. And obviously have been doing so ever since. In a way, have watched the evolution of the market, the growth of private lending, which is really the main thing that we do right now. But back then, when we started in 2007, 2008, it was much more opportunistic credit deal flow. And I think I'm pretty proud to say that I think we sort of actually created the credit secondaries market full stop back then.
Yeah, well, I mean, that was before the private credit market really got going as it is in its current form, isn't it?
Yes, exactly. Yeah, because really direct lending as an asset class, I think, really started post-financial crisis, in particular here in Europe. So yeah, it's been really fascinating to see that market grow and also see the potential for the credit secondaries market as a result grow substantially.
So what is the potential for it? How would you characterize the market opportunity in private credit secondaries?
At the moment, we're obviously still a relatively small part of the overall secondaries universe, but the market is growing very, very rapidly. I mean, secondaries is always a function of a primary market. And if you look at where people see the overall private credit market going, if you take very, very broad definitions of private credit, it's actually bigger than private equity. There's some people out there talking about 30, 40 trillion of private credit addressable market. So if you take that figure, I think it wouldn't take much to say that in the very long term, private credit secondaries could be bigger than private equity secondaries. But still, obviously, a very long way to go from there.
So credit is cyclical. Has it grown cyclically since you started?
I think it's a secular trend actually moving from bank lending to private fund lending. I think funds are better set up to provide longer term liquidity. And we shouldn't forget that credit is a long-term asset class. It's not short-term typically. I mean, loans are very, very long duration in essence. So I think the model actually lends itself to a closed-ended or a fund-driven investment model. So I think this is a secular trend, and more assets will move from banks to the big lending franchises.
So what are the seller motivations as we sit here today in 2025?
So seller motivations on the private credit secondaries, it's interesting enough, it is the same motivations than you have for private equity secondaries. And quite often it gets a question, I mean, is it different? Is it distressed sellers? Is it people that have special motivations? The market is so broad now that all the same motivations apply. I guess if you have a denominator effect, for example, it will apply both for equity and for credit secondaries. Sure. I think what one always needs to keep in mind, a private credit fund is very, very long duration. So you're not talking about one loan, which, I mean, in a bull market has a duration maybe of 2 years, and then it gets refinanced. A private credit fund makes obviously many loans, it recycles, has an investment period. So these funds are typically now, let's say, probably 8-9 years long, and durations are stretching out. So for that, it is one of the longest term assets an investor has in their portfolio. So if you need liquidity, it is the same reason as for private equity, because they're almost same duration in essence.
So it's long duration relative to other types of credit rather than relative to private equity, where it's probably slightly shorter duration.
It's slightly shorter, but then, I mean, like, it is still very long duration. If you have 9 years versus, let's say, 13, 14, 15 years, I mean, what's the difference? In a certain degree, it is still one of your longest duration assets that you have. as a pension fund or an insurance company.
We live in very volatile times at the moment. What's deal flow looking like?
Deal flow is good. Volatility is always good for secondaries by definitions, because people obviously take a step back, they reassess what they have in their portfolios, and then reshuffle. So that is a great driver for deal flow. It's not that we are reliant on that for market growth. I think that's a secular trend. It is happening anyway. But the volatility, I think you typically see impacting certain sectors more than others. So when you take a step back and you looked at what happened when we had the budget crisis in the UK, I mean, you had LDI, you had pension funds selling. So there gave a temporary boost, let's say, to the credit secondaries market. I mean, all this volatility now, it impacts everyone. So insurance companies will be impacted. I mean, pension funds are looking, endowments, obviously in the press, that they are reconsidering what they do with the alternatives. So I think all that volatility for us on the deal side is obviously a major plus.
How do you see the universe? What types of sub-asset classes, what types of credit do you get involved with?
So for us at Coller, we try to cover the entire spectrum, but we really try to divide it between senior risk, which we define as obviously your traditional direct lending fund that does senior might do unitranche, and then junior risk, which is more mezzanine, but we can also cover distressed funds, asset-backed funds, but that falls within our junior bucket in a way of that we invest out of. So we try to capture the entire market segment. But as we just said, obviously it's a market segment that's also evolving, or where people are doing new things in the fund universe, which traditionally were covered by banks, like working capital finance, for example, or other things.
What about the relatively new area of NAV lending? You get involved with that?
So NAV lending is really not a big focus for us here at Coller. We obviously observe the market, both from being an investor in many funds on our equity business. So we see what's happening in the market. Historically, we've done pref transactions out of our equity funds and the like. So we look at the market. We think it's an interesting market segment, but we're not a big player in that.
What's private credit value add? Because presumably to make money in credit, it's not so much about driving the upside as protecting your downside and making sure that you are diversified and your loss ratio is kept low. What's the skill set behind that? And what kind of loss ratio would you expect or would you target?
So is it for a secondaries play now, or for private credit as an asset class?
Oh, could you do the main market and then the secondaries?
Yeah. So look, I mean, I think for me the real value that private credit provides to I guess people that need credit is that compared to the traditional form of bank lending, I think it is more flexible capital. It is also more concentrated pools of capital. So typically it's not a syndicated market, which I think does give advantages to borrowers, obviously, because they're interacting with less counterparties. And also it is a setup where you have no mismatch between, I guess, the duration of the funds that a fund is taking in. It's getting money from investors and then lending that out, which is different to a bank. A bank obviously takes deposit in, so it could be short duration, and then is lending that out. So I think that is actually a real driver. And I think investors have realized that is a good way to participate in credit, in essence. So I think those are the real drivers for the growth of the primary market. In secondaries, I mean, like what you target as a secondaries investors, it is the same in private credit secondaries as is in equity secondaries. Look, a secondaries fund should give you diversification. That is obviously key. We only want to be exposed to high quality credits. So we do not tend to buy funds that have a lot of problem assets in them. We like to work with high quality GPs that have proven track records. It's all with the mindset of eliminating downside risk, because in the end, credit is not about upside. It's about eliminating downside risk and giving a solid and predictable performance. And that is the same in the primary market for credit as it is in the secondary market for credit.
So what's the primary skill set in your team then? Is it presumably it is assessing and scenario planning for the cash flows of portfolios of assets?
Correct. Yeah. So it's really understanding the loans that you buy in a secondary transaction. I think it is important to have people that have primary credit underwriting backgrounds in your team, because they, again, know how the sausage is made, which is important. So, but also you need to have that secondary perspective, because if you think about buying a big portfolio, we bought a portfolio 1.6 billion in size, 40 plus funds. You obviously have thousands of loans in that, and you need to be able to take that information in quickly, distill it down to what is important, and then focus on those areas where you really want to focus your due diligence on. So it is really, you have to have this secondary skill set of understanding broadly diversified pools of assets. And I think that is even more important, I would say, in credit secondaries than is in equity secondaries, because again, you don't have any upside. You only have downside.
How difficult is it to build up that secondaries skill set? Is it a technique that you can just buy in, or is your institutional heritage important now?
I think institutional heritage is very, very important, because it's the people and it's tricky to assemble, obviously, a group of capable people that have a long-standing track record in the industry, that have worked together for a long period of time. And we touched upon it, credit secondaries is really a market that, in a way, for most of our competition, started in 2021. Also, we started way earlier than that. So I think that is an inbuilt advantage that we have. But it's also a lot about, and it might sound boring, it's a lot about process. Credit is about process, and having institutionalized processes that are tried and tested. It is very, very important. It's simple things like, for an investment committee member, knowing where to look in an IC memo that can always be quite lengthy, and having all these structures. I think that is quite often underestimated. How important that is.
It's difficult to articulate the value of that kind of thing, which is why I hesitate to ask the question. But what I was going to say was, what are the levers that you can pull to protect your downside, given that it's so important? Like a bank would have had a workout team, for example. What's the equivalent?
Yes, for us, obviously, because as an LP in a transaction, we obviously just a replacement LP in the end. We buy a fund position. So for us, it's really to evaluate, do managers have that workout skill set? And it's interesting to your point, because obviously within private credit and senior lending, that hasn't been tested so far. To a very large extent, because obviously the industry came to its own after the financial crisis, where there obviously have been some hiccups sometimes, but there hasn't been a prolonged downturn as a result. So for us, focusing on funds that actually have that workout capability in the teams, either because they have people that have it, or as an institution they have it, that is actually very, very important. And we really wouldn't touch, I think, ideally GPs that don't have that skill set, because obviously when there will be a volatility and a shakeout, and it always comes, we all know it does, then obviously you can be exposed, I think, with those types of managers.
What's competition like in the private credit secondaries market?
I think it's, it is a competitive market. It's a bit of a, as I mentioned before, a hot topic. I think, everyone is talking about it. It's still interesting enough. It's always still the last panel of the day still. So I think there's still a bit of room at SuperReturn, bit of room still to go. But I think people have realized that it is an attractive market segment to be in, because it's growing. And obviously, if you're a growing asset manager within alternatives, you ideally want to be a part of it. I don't think it's going to be that easy, to be honest, for a lot of the new entrants, because credit, in my view, and you see that in the primary market, it's a scale game. So obviously you have a bunch of large players dominating the market, because in the end, it is about processes. It's about having access to a lot of deal flow. So I think the same will repeat in the private credit secondaries market. I don't think it will be a market where you have 20 or 30 large players. I think it will be much more concentrated than that.
The assets that you're buying are older, and so they come to maturity quicker. And so it's more appealing from a liquidity perspective. And obviously we've got the influx of, the private wealth market, which the private markets industry is trying to tap. Presumably private credit secondaries, I've got to get that right every time, is quite a suitable product for these semi-liquid structures that people are launching.
I think in general, credit is obviously an attractive product for semi-liquid structure. I mean, also if you think about, in a way, the heritage of a lot of these more evergreen type of structures really sits in credit in the primary market. So if you look at the BDC market in the US, for example, that is a credit market. And obviously the structures are slightly different, but it's the same type of concept. So credit in itself lends itself, to that type of structure because obviously you can recycle within credit. People like the yield element to it. And I think private credit secondaries is no different from that perspective. You make absolutely the right point because obviously some of it is also shorter duration. Actually, it lends itself to a more evergreen type of structure because obviously you can recycle easier the cash that you're coming back. And within a secondary portfolio, obviously cash can come back the day after you buy something in the end, because obviously you're buying thousands of loans in one go. So there's obviously one bound to be refinance the day after you acquire a portfolio. So the cash velocity is obviously an attractive feature of the credit secondaries product.
So we're sitting here in 2025. Would you be open to making an outrageous prediction about what, the level of this market, private credit secondaries in, let's say, 5 years' time, what maybe as a proportion of private credit, or even as a proportion of private markets? Do you want to stick your neck out?
So, if you look at sort of the secondaries market, normally between 1 and 2% of the primary market trades every year. And I think that has obviously been...
In general for secondaries.
For secondaries. Yeah. So I in a way, I don't see with a more general adoption of private credit secondaries and more knowledge out there about what you actually can do in this market, that these ratios shouldn't apply. So then I think the challenge is obviously what definition of private credit primary market do you actually take? But can this market get to these type of numbers where if you think about, let's say, a 3 trillion senior direct lending market, which I think a lot of people predict over the next 5 years, you take 2% of that would be 60 billion. So I don't think that's an outrageous prediction in a way to make. Can this market be at 50 billion in 3 to 5 years? Yes, I think so. Yeah.